Welcome back to the show. Today, we have with us the CEO of Emission Critical Technologies, Schaum Sethuram. Emission Critical is a SaaS platform that traces product lifecycle carbon intensity and automates transaction-level reporting. Schaum tells us that this is kind of like a carbon nutrition label on a product. Tell us more about how is that different from a lot of other solutions out there that are trying to do the same thing in terms of life cycle product assessment.
Yeah, sure. So first of all, thanks very much for having me. I'm really excited to be here with you. Yeah, absolutely. Thanks for that introduction, Nada. So we are developing a SaaS platform that simplifies and automates carbon lifecycle analysis. And as you kind of pointed out, it's sort of similar to a nutrition label. And so on that nutrition label, you might have, like, for instance, something analogous to your calories, right? Which would be your gross carbon footprint. Then you'll have all the ingredients below that, right? And, as far as the carbon context is concerned, it might be your scope 1, 2, 3 emissions. What's the breakdown of that? And then you might have a separate section on that statement that basically talks about, what kind of mitigation measures are you putting in terms of CCS or CCUS, any credits that can be basically earned and then applied for that specific product. So what really differentiates us is that, first of all, most of the emissions reporting solutions out there, and I'm talking specifically about software, is they look at just the scope 1, 2, 3 emission inventories. This is the stuff that goes on those sort of glossy sustainability reports, right? What we do, however, is we take that emission inventory, that's an input into our system, and then we add on details about the production process, and we add on details about the production routes as well. So how are the raw materials actually moving through the value chain? And then once you finally finished your product, how are you actually transporting it to the end customer? And those routes can be different. And so what we do is we take that energy consumption, purchasing data that's basically fluctuating on a month-to-month basis, and then create an emission profile for every single product. And as we've spoken about, you can think of that as like the carbon nutrition label for every product. Now, when I speak about product, I'm speaking product in a general sense. So a product can be, like a barrel of oil that you sell to your customer. It could be a project, like a transaction, or it could even be a service. And so what we are doing is we're doing the life cycle analysis of those specific things.
Yeah, so I'm curious what led you to starting this company. You said you've been you were founded about a year ago. And what was that moment where you decided that there's a need for this in the market?
Yeah, absolutely. So I've actually been in the field of sort of GHG systems tracking for, more than 10 years. I've worked, with some of the large energy companies. I actually had a consulting firm before I started Emission Critical. And in that consulting firm, which I ran for more than 9 years, we focused on tracking hydrocarbons in the value chain and then also tracking some GHG emissions as well. And so our customers were basically telling us that, that they were starting to become more mature in terms of tracking their scope 1 emissions, but that they really needed to kind of develop a much more comprehensive carbon footprint, and then specifically at the product level. So if you look at some of these large companies, they sometimes produce, hundreds or maybe even thousands of SKUs of different products. And so you'll have a different, nutrition label, if you will, for every one of those products. And so that's kind of what really led us, is that to kind of forming this company, is we surveyed the market, didn't see a solution that was really geared specifically around this. And we had some very willing customers who were, ready to sort of be our early partners.
Yeah. So I'm curious, making it a little technical here. I feel like when we talk about kind of measuring scope 1, scope 2, and scope 3 emissions, it's a big problem, right? And in some ways, you're trying to say, here are all the emissions a company produces. And I think most folks are kind of familiar with more of a Scrum process. You say, what's the small problem I want to solve first, and kind of build that up to a big solution. Yeah. And it's almost like the discussion though is saying, let's start big and try to get focused. So I think what's distinct here is you're saying, I'm gonna pick my lane of trying to really understand products. And then if you sum up all the products, then theoretically you should be able to kind of back into the overall emissions of a company. But do you see there's a reason why we are kind of approaching it from one way or another?
Well,
and which is easier, I guess.
Yeah, I think it's so developing your scope 1, 2, 3 inventories is a prerequisite.
Okay.
So, there are some companies that we work with that have absolutely nothing. So before you can even do any kind of product lifecycle analysis, you first need to develop that core scope 1, 2, 3 inventory. Then you can add the production details and the routes and so forth. So that's a prerequisite.
So it is a layer on top.
Exactly.
It's not really a grassroots kind of approach. It's really making more granular analysis.
Correct.
Okay.
You're taking the inventory down to the actual product. And it's just because I think we're still pretty early on as a market in terms of developing these inventories. So it's natural that companies would be focusing on trying to get that right first. But there are companies right now who are trying to basically, for many reasons, which we can go into later, to essentially bring that to the product level, because maybe they want to be more competitive, right? They want to sell their product as lower carbon and then, potentially secure more sales. Or there could even be opportunities to get price premiums. We're seeing some markets, especially in energy, where if you have a lower carbon product, like lower carbon LNG, for instance, right? You can secure a price premium over sort of, traditionally produced LNG or average LNG. And so we're seeing that in other markets as well, like steel, cement, and so forth. So that's a big driver as to why some companies are doing that now. There's also regulations. Regulations can come in the form of, tariffs, like they are in the European Union. You may have heard of the carbon border adjustment mechanism, which is basically putting a tariff on any product carbon footprint, right? Which will require sort of this life cycle analysis, assessment. So they will basically put a tariff on, what is the embodied carbon that you're basically, importing. So that's another reason why some companies have started to become very interested in that they're importing to the EU, therefore, and then also in the US, as we all know about the IRA as one example, as well as like California with a lower carbon fuel standard. And then there's the analogous EPA programs as well. They provide tax credits. So if you can justify and show through an LCA, hey, I've got a qualifying carbon intensity, right? Then you can secure tax credits. So that's directly to your bottom line, which is why there are companies who are, really interested in doing this at the moment. That's one of the big drivers.
And you describe it like a analogous to a nutrition label, which kind of points to me that you want to get this in front of end consumers at the end of the day, like on the retail side, where if I'm looking at my flight home to DC, am I going to be able to see kind of a carbon label at that granularity? Because I know they already tried to sell me carbon credits when I buy my airplane ticket.
That's definitely one implementation of it. So we are focused on sort of the B2B market.
Okay.
And the reason for that is because at the moment, it's really the largest companies in the world, the largest emitters in the world that are under scrutiny and pressure to decarbonize. So you want to go where the problem is urgent, where they wanted to solve this yesterday. The regulations and the forcing functions have not trickled down yet to the consumer. It's very voluntary, right? For you and me, whether I want to offset my flight or not, right? But for these companies, it's a matter of securing investment. It's a matter of being included in specific funds. It's a matter of increasing sales or potentially securing additional, premiums in sales.
Could you give us some examples of some of the use cases, some of the customers that you have? What kind of products are you talking about in this early phase of the company?
Yeah, sure. So we're very focused on heavy industrial products. Okay. So really energy, chemicals. We're also working with a steel company, cement, manufacturing. So broadly, these categories. And what we're looking to do is really work with some of the early adopters in these markets. Because if you look at the market as a whole, the regulations haven't yet quite hit. So really, it's going to be about working with those companies who want to be on the leading edge of this, who see value, and where your sale is not going to take like a year or 2 years, right? You want to be able to overcome that threshold, a lot sooner, especially for startup. Because that's like death to a startup, right? With these long sales cycles.
Who is the typical buyer within a company for this?
Yeah, so the actual push, because we're looking at product, right? And because it's being sold to an end customer, typically it's the commercial folks who actually drive it, who say, hey, I'm surveying the market. I have customers who are asking for lower carbon products, maybe even wanting to pay extra for them.
Mhm.
So then they work internally with their sustainability team as well as the ops folks and say, we need to kind of develop and operationalize a strategy for how we're actually going to get this data ready and also ultimately get it verified so that we can actually, capture these benefits on the sales side. So it's commercial that's driving it, but it's a cross-functional team.
Mm-hmm. And in terms of the output, I assume, you're thinking about it on a SKU level, but is this something where there's like a report generated annually, or is this more frequent?
Yeah, so it really depends on the type of business.
Mhm.
So if you look at an energy business, for instance, and they are, producing gas month on month,
Mhm.
right? Then we would do it on a continuous basis. So we basically would say produce a carbon statement for every month of production.
Mhm.
So that's sort of a continuous mode of production because they're selling it into the grid or wherever. We can also do it batch by batch. So if you're looking at, shipments, right? Like, you manufactured some shoes, for instance, right? And you've shipped 50 shoes to the warehouse for sale, right? That's something that we produce a statement for on a batch by batch basis. So really, the software is extremely capable. We call it continuous lifecycle analysis, which means we go down to the batch level and can do it. We capture multiple snapshots as time moves.
Yeah, no, you were saying shipments, and I know that used to be in shipping. And I was thinking there's a difference between a very dirty old ship and a new like ammonia powered ship. That life cycle would actually matter in terms of the shipping container.
Right. Yeah. And then when I talk about shipping, I'm talking more broadly as well about cargoes.
Yeah.
Cargoes and the batches of products that you're actually selling to customers.
Yeah. Interesting. And what do you think? Why was now the time, really? You said you started this last year. Like, what was the moment where you said this was the year to do it, not 5 years ago or not in the future?
Well, I think we started to see a lot of momentum build up from investors and regulators. So if you look at the regulatory landscape, for instance, right, we all knew that carbon border adjustment mechanism was coming down the pipe. We didn't have all the details, but we knew that it was on the horizon. We also know that the EU is very progressive, right, when it comes to sustainability. What was interesting to me personally, being based in the US, is I started to see that on our side of the pond, that there was bills being proposed to actually mirror the carbon border adjustment mechanism. There's something that's been proposed called the Clean Competition Act, which is essentially kind of a mirror image. And what's noteworthy is that it has bipartisan support, and so that is, in our current political landscape, extremely important, right? So I think from the regulatory perspective, it was clear to me that the tailwinds were there. And then when you look at it from customers, I having worked in energy for most of my career, my first sort of set of feedback and validation was coming from them, from my previous customers, right? And so I started to get a lot of positive feedback from them about saying that they wanted to do this, and they were trying to, satisfy sort of the sales requirements and kind of develop this product carbon footprint. So that's kind of where a lot of this coming from.
Yeah. I kind of want to dig into the tax, because I think sometimes we're trying to unpack like carbon credits. We were unpacking RECs last week. Is this just is this a complex another mechanism people have to understand and certify against, or is it kind of interchangeable when we talk about carbon credits? And I know there's no such thing as a single carbon credit, so help us kind of understand how it's maybe the same or different.
Yeah, sure. So when we look at life cycle analysis, what we're really looking at is the complete systems, the complete sort of accounting. So you can divide the accounting ledger really into two sections: the emission side, or liabilities, and then your offsets or credits, right? So what we focus on is the whole system, right? And we focus on generating that statement and then using that data for analysis to help companies reduce their emissions. Yeah. So the credits are basically an input into what we do. We may not necessarily be very all consumed with what credit and how it was developed, because that's usually kind of verified and sorted out by somebody else. But that is an input into our system. And then what we do is we take that and then we allocate it against the product. And so you could choose to allocate that credit, for instance, to, one batch of product, or you could choose to allocate it to, another batch, right? So you have a lot of decisions in terms of what is your customer asking for? Some customers are asking for carbon neutral deliveries, right? And they're willing to pay a little extra. So then you procure some offsets or credits, and then you can basically apply them.
Yeah.
Okay.
So I understand. So there's some of it is accounting in terms of how you want to allocate the credit resource.
Yeah.
But I guess my question is, when you show up at the border, and I assume the tariff isn't in place yet, but like what's the expectation for what you actually need to show at the port of entry?
Yeah. So what you need to show is a statement that basically outlines, okay, batch by batch, what is the product carbon footprint? What are all the emissions incurred to create this product? And you also need to do it itemized by batch, and it also needs to be reported quarterly.
And so that's part of why you're able to go to the batch level and the time level, is because you can do that. And I guess my question is, who certifies that? Like, or what are they looking for at the border to know that it's not me, Jason, making it up, but it's actually an expert making it up?
Yes. So it's all of these statements ultimately have to be verified by a third party. So in the same way that you might verify financial data, like an EY or KPMG or any of these entities would verify financial data, you have analogous firms who are basically specialized in verifying this information. Now, with the tariff that we're speaking of in question, because they realized that the burden of the tariff in terms of companies trying to prepare this data is high. So what they've said is that for the first few years, you don't have to have the data verified. You have to start reporting, but it's essentially a transition period to get you ready so that, come 2026, that's when you'll start to have some verification requirements. And then there will actually be, penalties on, if your carbon emissions are essentially higher than what they're producing in the EU.
Interesting. Okay.
So I'm wondering how, what's your vision for Emission Critical Technologies in the future? What would it look like compared to like what you're trying to do today is like through these small use cases in an ideal scenario? Yeah,
so I think we're trying to take it sort of industry by industry. We're working with several early adopters in each industry. And ultimately, we want to become sort of a system of record, potentially even what we call a certifier, not a verifier, but a certifier of data, where we can look at, like the nutrition label and essentially give you a score and say, okay, you get, grade A, for instance, right? And then that can be a signal to the market to say, hey, I've got to come in and pay attention to this because I'm in the market for lower carbon products, right? So I think that's kind of where we'd like to get to. And ultimately, the vision really centers around accelerating the low carbon economy. I'm a big believer in market-based forces. We can't rely on the government to help us because it's going to take too long. Regulations are going to come, but they're going to take their own time. So, and that's why we're really focusing on this problem, is we feel that it's really the end customer who is ultimately going to have the biggest impact in the near term to actually drive change, right? And to force companies to invest money and resources to actually decarbonizing their operations.
So it'd be like another kind of standard body that certifies and says, it's like kind of has your stamp of approval on it and says, this is, maybe a grading system or something like that.
Yeah, I think the way we would look at it is, first it's our software, right? Yeah. Then after that, once we've got that sort of in place and we have product market fit, then we get to the actual data itself. And that's where, we could actually start to sort of stamp out or issue, certificates or something to basically show that, hey, we've produced this data according to all these various standards. And, on this scale, 1 to 5 scale, you're a 1 or you're a 5. And then that can be a signal to the market in terms of what they need to pay attention to. And it also can, alleviate the sort of engagement time that auditors have to actually come in, because if they've got a sort of established guideline already there, and the system is providing full traceability in terms of formulas and calculations, it's a lot easier for them to come in and, give you reasonable assurance, as opposed to what's happening currently, which is, you have black box systems. These are not easily auditable. And so the engagement time goes up and therefore costs go up.
So you want to make the system more transparent. And at the same time, like what would really be required is that level of trust, right? Like that we can trust this company to be able to come in and then evaluate a lot of different products.
Yeah, that's correct.
So how do you think you will work on like gaining that trust from the industry? as a startup? What are the challenges you foresee?
Yeah, I mean, I think you have to approach the problem in a step-by-step way. So I think it's really first amassing a critical mass of customers, in these various industries. And so that's really what we're ultimately very, very focused on right now. Once we have that, standard bodies and certification agencies will start to pay attention to us, just because we will start to become more of the dominant player in the market. Yeah. And so that's we think that's going to happen really organically. We're certainly in touch with some of the bodies already and trying to develop those relationships. But obviously a lot of it is what's your footprint, sorry, pun intended, in terms of the actual, customer landscape.
I always thought it was like a funny shift when I was running a startup where, you're the expert in kind of the lifecycle analysis. And at some point, the regulatory bodies like pick up on that and they go, "Oh, he's the expert. I need his opinion." And you think to yourself, "Well, I'm just a little startup." But the reality is, there are only so many experts. There's a reason why founders decide to jump in and take the leap. And I think before we turned on the mic, we were talking about having a seat at the table,
right,
and really discussing kind of where the industry goes gives you that kind of ability to chart out, where this industry and where this mechanism needs to go, because people are going to recognize the leadership. So that's part of just being there. Right?
Yeah, absolutely. And I would even take it one step further. It's not just about being a subject matter expert. It's also about sort of productizing that in a software product, because the whole point of using a software product like ours is that you basically simplify and automate the process. You can go from like a one-time static lifecycle analysis, which is has a high data collection overhead, requires a high level of expertise, to a software that has all of the guidelines and rules already embedded, right, and can produce the statements on a continuous basis.
It's a standard, essentially. Once it's kind of coded in the process, it's coded in, and that repeatability makes it valuable.
Exactly. So it's that we're really focused on that, systemization or productization of the various guidelines. And some of these guidelines are hundreds or even thousands of pages in length. So it is quite a task to basically be able to put it into a product that can be, used in a user-friendly way by end customers. Because one of the biggest pieces of feedback we've received from our customers is basically that they want to be able to configure it themselves. They want it to be self-serve. They don't want to have to necessarily call in expensive third-party consultants to come in and do it for them, right? So because they have their own expertise, and so that's kind of what we're ultimately providing.
I was curious to get your views on, there are a lot of companies that I'm seeing pitching these days that use blockchain technology to trace these emissions and keep track of them. And what's your view there? Because you're not using blockchain for this solution.
Not at the moment. It's in our kind of roadmap, but as an option. We've seen different approaches to this. So there are some kind of let's say sustainability bodies or nonprofit entities who've essentially developed platforms for data exchange. The whole point of blockchain in this context is really around data sharing, data exchange between counterparties. So there are some non-blockchain solutions already out there for specific markets that allow counterparties to basically exchange data, and then you can basically trace the life cycle of a product, right? So if you look at an energy example, you could look at crude oil, and then what does the crude oil turn into? Okay, it turns into jet fuel, and it turns into tar, and et cetera, right? And then that gets turned into chemical products, and then that gets turned into packaged products and so forth, right? So you can basically visualize all of that, on one of these platforms. Blockchain is just an enabling technology. There are some advantages to using blockchain over some of these platforms, and then there are some disadvantages as well. As far as we're concerned, we're trying to focus on that early problem of trying to essentially get the product carbon footprint data robust. Right? Because before you can start to kind of get into blockchain and share data with counterparties, you need to make sure that core data itself is well prepared. And so that would be a logical next step is, okay, what is the data sharing mechanism, right? And then blockchain could be an option for us. And we've already started to talk to a few companies about it, but that is not necessarily the immediate priority. Immediate priority is we need to get this data ready.
Yeah, and data, 10, 15 years ago, there were still a lot of questions on like getting the right amount of data and collecting that data and being able to trust that data. How do you think that has evolved, especially when it comes to emissions data? And what kind of data is important for you for this solution?
Yeah, sure. So, our solution, we don't just look at the emission inventories, right? And that's, I think, we're sort of in the lifecycle analysis bucket of software. And so we look at the production information, the sold quantities, and how much was purchased, as well as, the pathways that the raw materials and products flow through. So we're looking at different data streams, first of all. But we take input from these, emissions reporting solutions. Now, in terms of the data, I think, the main thing that companies, in our opinion, have to be focused on is making sure you have defensible data. Because, you have to look at your specific case and kind of ask the question, how good is it good enough? Right? Because you could
go pass an audit, essentially.
Yeah,
right?
that's what we mean by defensible, right? Yeah. It needs to pass an audit or withstand some kind of scrutiny, right? At a minimum. Then you have other kind of forcing functions, like, for instance, the tax credits and so forth, that offer benefits if you can actually further reduce. So there isn't like this minimum threshold you meet and then you're good. It's like a progressive scale where the more you lower it, right, essentially the more benefit you can get, right? And so in those sorts of instances, that's where companies will have to maybe invest in better sensors or better modeling technologies to essentially, fill in those data gaps. Because as everybody knows, when it comes to emissions data, there are a lot of gaps, especially as it relates to scope 3, right? And there are companies out there who are trying to solve that. And scope 3 does pop up as well, as far as we're concerned, but it's more of an input to kind of what we do.
I feel like 15 years ago, data, it wasn't like such a background part of our lives. Like it felt like it was expensive to have a lot of it. And I was at a conference last week, and the assumption was, well, storage is essentially free at this point because it's so cheap. You might as well just capture everything and maintain a registry of it too.
Yeah, sure.
Right. Whereas I don't think that was the conversation 15 to 20 years ago. There was still that kind of premium. And so it was really a question of like, what's too much?
Yeah.
And now it's just like,
throw it all in. I agree. And I would supplement. It's not just about being in the cloud or storage being quick. That's one part. But it's also the data technology stack itself has evolved. And so data science as a field has really evolved. And so it's, increased our ability to basically fill in data gaps where maybe we don't get data from suppliers, or we don't know how the end consumer is using our product, right? So I think definitely the technology stack evolving has really kind of gotten us to a place where we can actually do something.
Yeah, I was curious about a little bit just about your background and how you made that leap to start your own company, having, I guess, worked with corporate most of your career. What was that moment like?
Yeah, sure. So I've worked in the energy industry my entire career, and focused on these sort of enterprise system solutions, tracking hydrocarbons as well as tracking some GHGs. I actually left the corporate world as an employee after about five years. And then I started my own consulting firm, actually. So I had sort of founded a business already and ran it. And I ran it for about 9 years and consulted with various companies in the, the sort of who's who of the energy industry, very related to what I did in my corporate career. So I already have some experience running and founding a business, even though it was a consulting business. Now, as we started to hear more and more feedback from our existing customers when I was in the consulting firm, they started to ask questions around, okay, we want to track carbon emissions the way we track oil, gas, and water in our operations. We want to have that mindset. It's like the fourth fluid. When I started to hear this sort of narration, I started to realize, okay, these guys are starting to get more serious about this. And then they wanted to understand what's the emission profile at the product level. And so all of these questions spurred, myself and my co-founder to basically survey the market and really look at if there was a solution out there that was already doing this. And there are some solutions doing the sort of one-time static LCAs, but not many at all doing sort of this continuous dynamic LCA. And so that prompted us to actually close down the consulting firm. So I actually closed down the consulting firm and then formed Emission Critical, which is a product-focused business.
And how did you find your co-founder?
So I actually found my co-founder through Y Combinator's matching program. So, I had already kind of had some initial interest from customers, had a decent idea of what kind of product I wanted to build. Now, I was very cognizant of the fact that I have, product expertise, domain expertise. I had run a business before, but I really wanted a strong partner who was strong in the software engineering space. And so I found a gentleman by the name of Mohit. He basically is a second-time founder. He actually successfully exited his previous startup just about 2.5 years ago. And so he was really looking to get involved in the environment. He was very passionate about climate reduction and climate action. And so, we really sort of clicked in terms of our values and what we wanted to build. So yeah, that's kind of how we met. And then he also, because he worked at a previous startup, he also had access to very high caliber software engineering expertise. So we could start a team immediately. It wasn't like we had to go out and recruit people one by one. He came already with a network. We onboarded several people right off the bat and then created a solid nucleus of software engineering. And so that was another very compelling reason why, I thought it would be a great partnership between us.
Yeah, I have a statement that I want to ask a question. So I got approached by a founder, 2 weeks ago, asking why don't investors want to come to Houston? This is the reason why investors don't want to come to Houston, because when you invest in a Silicon Valley company, you can get a team and you can just get the product so fast. Whereas here, we're it would take us 2 years to do the same thing you probably did in 6 months. And so anyways, I don't know if you have a reaction to that.
Yeah, no, I do. I do think it's getting better.
Yeah.
I mean, I definitely am living that pain, because as we're trying to recruit, I think that the resources in the Houston area still are not quite at the level of, Silicon Valley. In terms of trying to, get access to the right expertise. We know it's out there. I mean, Houston has plenty of incredible expertise. A lot of the expertise in the core energy industry is going to be so applicable in the energy transition as well. Being a part of the Rice Clean Energy Accelerator, also regularly attending events at Greentown, have made me extremely optimistic about the future of, the startup innovation, landscape here in Houston. But yeah, I mean, I definitely agree with your point that I think, especially as it relates to early stage capital, I would say early stage capital is still a bit thin in Houston compared to, other places. It's even compared to, I would say, New York. I also think that the risk tolerance also is generally lower as well, is what I've seen. Because, we've spoken to investors in California and in Houston, and essentially the same amount of risk, we're finding that there are folks in California who are willing to pay more. They sort of see the payoff. They kind of they have that mindset of being wanted to take more risk.
I want to go back to the YCOM matching program for a little bit, because you're probably the first one I've met who've gone through that. How'd you get in? What was the process? They like Houston founders?
They take founders from everywhere. So just to be clear, we the matching program is just basically a portal. Okay. So you can basically go and create a portal. Anybody can do it. Okay. Anybody can create, a profile, and then you have essentially a database of other, founders, other individuals who want to work in a startup. And then you could basically just message them. Okay. Right. And then engage them and then set up time to learn about them. For me and my co-founder, we did a few sprints to kind of try things out. So we had sort of this transition period of, okay, let's make sure that our chemistry is good. Let's make sure that we work well together, etc. So that's what we did. So, and, as far as the matching portal is concerned, there is no requirement necessarily to be part of YC. The YC program in and of itself is something separate. That is, that's very analogous to like the Clean Energy Accelerator. So
I'm curious why they do it. was there a mechanism to try and understand what you guys were doing, or did they have any curated programming, or was it really just a hands-off web portal?
Yeah, it's just a web portal just for co-founder matching, and it's just a resource that they provide because based on popular demand.
Okay.
One of the toughest things, and I found this as well, is that trying to find the right co-founder. You have a great idea, but you can't do it alone, right? You need to find somebody to partner with. So finding that person is an arduous process. I talked to more than 50 people. Before I honed in on someone.
Okay.
And there's a lot of things have to line up.
Yeah.
It's not just chemistry. It has to be the right time. They have to have the flexibility and the mindset to be able to work in a startup, understanding that the payoff is going to be kind of in the long term and not in the short term. They have to have financial flexibility as well to be able to give a startup a chance, right? Because if you've got a lot of bills on the table that you need to pay, you're less likely to jump into a startup. So.
Did you find that group specifically with YCOM? Like, are they software? Like, were they only software? And did they like climate?
Yeah. So your climate's recently become a big focus of YC. Obviously they've kind of really garnered a great reputation as far as software is concerned. But they've started to really diversify into hard tech as well. I personally think Houston's strength is in hard tech. In fact, when I was in the Rise Clean Energy Accelerator, I think we were one of 2 software companies in that entire cohort. Okay. So I think hard tech founders, and that's why I think a lot of hard tech founders do come to Houston internationally. But YC and others are looking at that and saying, hey, we can do it too. So.
And what has the funding journey been like for you now in the first year?
Yeah, sure. So, there's funding from myself as well as from my co-founder, and then we have some angel money, and then we've just started to raise a seed round, basically.
And has, you mentioned like it's been easier to get funds from like Silicon Valley. And so right now you said it's family and friends.
Yeah, it's I would say angels. So angels can cover kind of a broad spectrum. Some are ex-colleagues. Some are just folks who are really interested in what we're doing. Yeah, I found some of these folks as well on the Rice Clean Energy Mentor Network. Okay. There are some angel investors.
They are from the Houston region. Being able to get angels from here, I think that's good to know. Yeah.
You can. And then also myself and my co-founder have actually put in some money. Both of us have ran successful businesses before. And so we wanted to also have our own skin in the game too.
Did you do safe notes?
Yes.
And it sounds like you didn't necessarily go to one of the angel groups in Houston. It was really saying, I have a safe, please come in.
Yeah, it was more one-off networking. Yeah, we didn't necessarily go to like Han or those sorts of networks.
Yeah, I find
we may. I mean, it's something that we're looking at right now. Yeah.
And I find a lot of founders that we run into here struggle with getting those first checks in.
Right.
And so some of it is, you always say go to friends and family. But I think the other challenge sometimes is it's kind of a grind. You have to collect every safe and every check.
Right.
How was that process for you? Or how did you know this was the time to pull in capital?
Well, we needed to establish some kind of runway because the thing is that, since we are in sort of the enterprise software space, the sales cycles, whatever you think they are, double them. It is brutal, so, if in this game, you really need to have some runway. So almost immediately you need to start, and especially as a CEO, that's kind of one of the main responsibilities of a CEO is to raise, right? Yeah. So you're always thinking about that, especially early on. Now you can be tactical about it and say, okay, I want to put my best foot forward. So when I go to the investor, do I want to go with some contracts already under my belt? Or do I just go in, with my idea and my vision, right? That's kind of a tactical thing. I think that worked, a few years ago when, valuations were a lot higher and, investors were willing to take more risk. Now I think that that has come down quite a bit. So I think the bar has been raised in terms of, what qualifies for real venture capital.
Yeah, and I mean, in reality, that's how it should be, right? You should have some kind of a minimal viable product that people can bet on and invest in.
Right.
So I think that's what we're seeing now in this market is also a lot of companies who maybe don't really have anything being weeded out, and the ones that are going to remain over the next couple of years. They say this is when you get the next, Facebook and the big Amazons that come out of sort of the downturn.
Yeah, no, I agree with you. We saw that with the dot-com bust, right? Is that like, it wasn't as if, the internet went away. It's just that you had, diamonds that sort of came out of that, right? Like you said, Amazons and others that came out of that dot-com bust. So I think we could probably see the same thing even in the blockchain world as well, where, we're sort of in this, winter, if you will, right? As far as like cryptocurrencies and so forth are concerned. But this is where the diamonds get formed, the ones that are really going to be, running sustainable businesses.
And what's different really about your solution compared to maybe some of the others that come on here, it is still a SaaS product.
Yes.
And investors are more likely to go to like a SaaS tech type of solution because they expect big returns. What are your views there in terms of these climate tech technologies that are coming up and like the big returns that investors expect? And what's really needed in terms of perhaps a change in mindset for being able to fund these kind of solutions?
So I didn't get the first part of it. Sorry, could you repeat your question?
I guess there's a question of like, usually in climate tech, people are doing hardware, right? To get a big company off the ground, you got to put in like $200 million. But
it's like capital intensive.
Yeah, understood.
But software is intrinsically not capital intensive, but you're still solving a big problem that the industry's faced.
Yeah.
And I guess is there a difference in an investor? Like, are you only talking to software investors, or do you find uptake an interest from like more traditional, but like I guess energy and climate investors? Or I don't know if you've even started that part of the roadshow yet.
Yeah, so I think it's very important, from our experience, to speak to investors who have a thesis. Because if they've got a thesis, they're more likely to make a quick decision, whether it's yes or no. And that's what you ultimately want. You don't necessarily want to have this extremely long courtship between you and the investor, because as a startup, time is what kills you, right? Yeah. So I think it is really important to have a thesis. So whether their thesis is, yes, we do think a SaaS product can be successful in climate in your particular field. And then the second thing is yes, we've already made software investments and that we are relatively prolific in terms of investing, right? They don't just do one investment every 2 or 3 years, right?
Oh my gosh.
So you really have to kind of select your investors carefully for your own benefit, so that you can actually, because raising money, as everybody knows, is very difficult. So absolutely. I think we're looking at we're trying to look at funds that have done some software investments already, and don't look at software as an outlier. And there are some that we've spoken to who said, well, we've only done 1 or 2 software investments. Most of our stuff's clean tech, etc. And or hard tech, I should say. And, we realized that, that bar is going to be really tough to cross.
So one of the things that I came to learn is that, especially for software, it's very metrics driven for the investors. Once you hit a certain inflection point, usually after Series A, and then in climate, maybe I don't know if there are metrics even to look at, because you're kind of straddling this line. How do you think about where the business needs to go and kind of like the next milestone you need to hit? Is it 90% metrics or is it 10% metrics? How do you think about that?
Yeah, it is very metrics driven. Yeah. So at the seed round, probably not actually. I think having some early adopters and some evidence of traction is all that's sufficient. But once you start raising a Series A round, then definitely starts to become much more about metrics. And, in terms of what's your customer acquisition cost, what's how many customers are you onboarding per month, and kind of like are there any network effects? Because ultimately investors are looking at, how fast you can grow. So I think those metrics will become very, very important in our next raise, not in the one that we're currently doing.
Okay. When you think about, I guess, kind of the pathway ahead, are there any roadblocks you're seeing, either internal or external to the business?
Yeah, sure. So we've just started to raise, and I think one thing that we should have done is probably have tried to even raise a pre-seed round. Just because, as I mentioned, these enterprise sales cycles are very long, and having extra runway, allows you to be much more flexible in how you attack the market, because the early startups have to pivot a little bit. You don't have to do major pivots, but you have to do little pivots, based on what you're learning from your customers So I think that's one part of it. One of the reasons why we didn't necessarily do a pre-seed is because typically pre-seed valuations are not very attractive, right? So, and we thought we had something extremely compelling. We still do, but that also in the short term makes our life a little more difficult.
Oh man, cash is king.
Yes.
Right? So tell me, it's funny because when I started, whatever it was, a decade ago, it felt like seed was a new thing, and then pre-seed emerged in the last like 6 or 7 years.
Right.
What really, like, in your mind kind of demarcates when a company is ready to be seed versus ready to be Series A? And is pre-seed just like two guys and a dog? Like, where's that line?
I think it's sort of like, it's sort of idea, then you have like product, then you have, revenue. I would look at these 3 stages, So if you look at just an idea, you're really at a sort of a pre-seed level, right? Now, people change the labels because depending on how much you raise, and if you raise $5 million, nobody's going to call that a pre-seed, right?
Well, it depends on if you're in energy and you're building like hard tech.
Okay, fair enough.
But with software, we're talking software. Okay.
So it really depends on the relative to what others are raising there. And then obviously, going from idea to then you have product, like a minimum viable product or something. That's when you're starting to approach that seed stage. And then when you have a bit of revenue, that's an even stronger pull. So I'd say when you have a bit of revenue, plus you have, a product that is commercially ready, right? That's when, at least in software space. In hard tech, it's different. In hard tech, it is very different because some hard tech companies don't get to, the TRLs are such that, it'll take them a lot longer. It might be a Series D or E by the time they have something commercially ready.
Yeah. So I'm going to say what you said, but maybe translate it in a different way.
Yep.
Pre-seed is you have an idea, maybe a proof of concept.
Right.
Seed is the stage where you are able to proof of value. Where you say, look, we've tested it. Someone seems to like it.
Validated.
And Series A is where you have maybe product market fit or proof of fit because now you've sold several.
Correct.
And that's one way to think about like what stage. And we always ask the question because hardware makes it complicated. But I think there are good kind of points where you can say, like, this is why I'm going to raise the pre-seed because this is I'm indicating to the market, this is actually the stage we're at. Right. Yeah, that's helpful.
Yeah. The other thing I wanted to add too, in terms of like roadblocks, is obviously sort of the enterprise sales cycle being long is something that we are thinking about a lot. How to increase our sales velocity. We've started to develop some strategies around that, but it's still generally going to be, at least with the very, very large companies, it's going to be.
I would assume your biggest quarters are going to be fourth quarter in the last 3 weeks, and in Q1. Is that typical for like a B2B model in Houston? I just assume because people have to spend the budget they don't spend, and then Q1 is when they get all the budget released.
Yeah, so I think it makes what you're saying is correct if you're doing sort of small scale proof of concepts. So if you're doing a pilot or proof of concept, and like you said, there's some budget left over, companies are willing to do stuff, right? But if you want an actual annual subscription SaaS type contract, that typically has to be placed into a budget for the next cycle, right? Yeah. Because they're not allowed to spend money that they haven't applied for. So,
and that's what draws the long times. It could literally be a year from when you get the commitment, and things obviously can happen in a year.
Yeah.
But you also need to inform the customer 6 to 12 months ahead of them actually making the decision to order, essentially, right? So that's where it could reach 2 years if you're very unlucky. Right. And you want to make that faster.
Right. I mean, even some of the companies we're working with right now, they really like what we're doing. Having said that, they say, okay, we're going to put this as a line item for next cycle, which might be in January or February next year. And we're like, we want to get going now, so that's the nature of it.
3 months, 2 months.
Yeah, and having worked for some of these corporates, I know how hard it is to get a new software company and say, we're going to have this contract. So what are some of the challenges that you've seen there? And I know you've said it's a long sales cycle, but it's not even the length of the sales cycle, but finding that right person who can sign and say, okay, we're going to risk it with this startup.
Yeah, absolutely. So you've highlighted on 2 important things. One is all these large corporates, generally, it's a consensus decision. So even if you find a budget holder or decision maker, it's usually several people who have to come on board before they make the purchase. And that itself can, lead to kind of these longer sales times. The other aspect is they have to just have the mindset of being ready to work with a startup. Some companies we've spoken to really like what we do, but they're sort of, they're risk averse, and they ask questions about, well, are you guys what if you guys get taken over? What if this happens? What if that happens? And, envisioning all sorts of scenarios that, to me seem a bit nonsensical, but that's just their mindset. Yeah. That's how risk averse they are. So I think it is really important to kind of select your early customers carefully. I think it really helps that if the large corporates have a CVC associated with it, because then there is a history and a relationship of actually working with startups in the past. And that's kind of where we've actually had some initial success, is that, some of the CVCs we've worked with have been able to help us get proof of concepts and so forth. So
so that's a good strategy. Go with the CVCs because they have an incentive to build these relationships, because it's, in the end of the day, that's what it's really about, building that relationship so that someone can vouch for you in the system.
Yeah, a lot of it is trust, right? Especially when it's startup, because if they don't know you, and they have the choice in terms of software to go to one of the big incumbent providers. Right, they have to really go to bat for you and be a champion for what you're doing internal to the company, and so that's what you really need, and that's what we've tried to do, is try to find supporters and champions who think that what we're doing really would add tremendous value.
Man, it's already 10:30.
Yeah, so we ask usually about Houston and the ecosystem here, and you're a local.
Yes,
you're from
I've been
Houston.
here since 2007. I think that qualifies.
Yeah,
me, so.
Yeah, I guess so. So tell us how you've seen maybe the ecosystem evolve, and what are some of the gaps that you see still as we further build our ecosystem here?
Yeah, no, I think definitely, since I've been here since 2007, I think, I've really been excited to see Greentown. I've really been excited to see, the Ion, even sort of the Canon, for instance, like just a lot more resources for entrepreneurs. I think where I would like to see it develop further from a selfish standpoint is to kind of have more interest in software, because I do think, Houston is a great place for hard tech. But when it comes to software, it's a little thinner. I think earlier stage capital, as we've spoken about, we need more, investors ready to do that. And then I think you're going to naturally see even more companies want to relocate here. Yeah. They're going to say, hey, we want to come to Houston because, our customers are energy and chemicals customers. They're all here. And I have investors here. Yeah. Because a lot of investors, too, early stage investors, they like to have companies that are close by. Like they want them to be in the same, state or the same city, just because so much of it is trust and being able to kind of touch and feel, if you will, your investee. So I think that's really, really key in an early stage startup. And having that locally would I think be a huge boon to Houston.
And what are some of the gaps that prevent having more of a software industry here? I mean, aside from capital, but what else would we need to kickstart that?
I think it's a mindset. I think energy, heavy industrial companies, I don't want to talk just about energy, but are generally kind of, they're slower moving. They're generally more risk averse. And it makes sense because they have safety considerations. They have a lot of other things that it's not like a tech company that can just pivot very, very quickly, right? So I think it's that mindset of saying, hey, I see value in software and I'm willing to work with a startup on software. That's the key part. I think that's where we'll start to see the ecosystem improve, because I've been in discussions with several companies who really like what we're doing, but at the same time they're not yet ready to make the leap to work with us. They say, okay, well, come back to us in about a year when you kind of have progressed even further. And so what we're trying to do is obviously work with those who want to be on the leading edge and who want to actually work with startups.
Yeah, and what I also see here is there's a lot of focus on building accelerator programs that are heavy industry focused here, because that's what people know. That's the people who want to launch these programs. That's their background. Sure. And I think it's a very valid point that we need to focus also on the digital technologies, because they're going to go hand in hand.
Absolutely. Every hardware now has some attached software. I mean, it is just part of the what you're delivering ultimately.
But it has to be a deliberate focus. It's not going to happen on its own because it's not the natural place for technology innovate, that kind of tech innovation. Yeah.
And there, software adds tremendous value to the energy transition, as we all know.
Yeah.
So, I mean, there's a lot of, ready, willing customers here in this area. So,
Yeah.
so absolutely. But yeah, I mean, I think these accelerator programs for sure, with our acceptance into the Clean Energy Accelerator Class 2, there are other software companies who've also been part of that and had success, right? So I think we're starting to see, software grow, I should say, in terms of representation. So.
Yeah. And it's funny, we did an exercise over at Lambda last week, and it was trying to rank, okay, what do technologies have that potential for impact, and we can do it on a short period of time. And so if impact's on the right, and well, I'm going to do this on the left. If you were trying to put stuff in the top left corner, the two topics that were nearest term, highest impact were implementation of AI and then implementation of carbon accounting with software,
right,
both for products and for company emissions. And so I think there's a recognition that software,
right,
especially in the context of energy transition and managing it, those are the places where we can deliver a lot in the near term. But there's that kind of internal barrier of how do we kind of block and tackle quickly around software, which is maybe not something we're used to. So I think it's very timely for you to absorb that. So we talked about some of the changes in the ecosystem. Are there any hidden gems or resources you find that have been fantastic for you guys?
So I think the two that I've harped on already in this podcast, I think Greentown and I think the Rice Clean Energy Accelerator also is one of the most supportive ecosystems out there. They have a great network as well. They have connections into many large companies. And that's what you need, right? You need those connections because you need that initial trust. You need somebody to be able to say, hey, I want to work with a startup, right? I want to champion what you're doing. So I think definitely Rice Clean Energy Accelerator, what the Rice Alliance does. I think Greentown is also fabulous. I think Greentown gives a different view, meaning, Rice is very much focused on energy and energy transition. Greentown is kind of a much more broader, right? They're looking at chemicals, they're looking at utilities, they're looking at a lot of different things, right? Mining, trading companies, and so forth. And so we see all those as potential markets for us. As I mentioned, we're trying to work with sort of the early adopters, right? And we find early adopters in various industries, so heavy industries.
Well, as I guess as we wrap this up, is there anything the audience here could potentially do to help you guys out?
Yeah, sure. So, I mean, we are sort of raising our seed round. So if there are any investors out there who would like to learn more about us, they can certainly contact me at my email, schaum@emissioncritical.io. I'm also on LinkedIn. If there are any companies out there who are actually, interested in learning more about us and seeing if what we do is applicable to them, we definitely would be delighted to speak with those folks. And then if there are any engineers out there, who are looking to get involved in climate, who think they want to be part of something young and special, please do reach out, because we are on the hunt for additional expertise.
Good. Well, thank you for being here with us.
Thanks for having me.
Thank you.